How did Vanguard funds do during this latest crash? This is part two, second take of this, because the last one I did, I had a mistake on the latter part of this video where we're going to compare the S&P 500 65% in the Ginnie Mae 35% to the Wellington Fund. We'll see how those two did against each other. And a number of you pointed out that I made a mistake in there. So mucho gracias, as we like to say in Spain, or Peru. I've been to Peru, Honduras, Panama, Mexico. I guess that's pretty much it. Peru, Honduras, Panama, Mexico. And so that's what we say down in Latin in South America and North America too, Mexico. What did I just say? Mucho gracias. All right, so let's look at this. So I'm using five funds which I don't want to say I like necessarily, because I don't like BND. I don't really like corporate bonds. I just don't like corporate bonds. In fact, tomorrow I'm going to join a conference call with Wellington Investment Management Firm, and they it's a question and answer. We'll see if I get in my questions. Every time I ask a question, these conference calls, it never gets asked. So I think they already have their questions they want to answer already, but I'll listen to it. I think it'll be interesting. All right. So again, we're going to show you the year-to-date, the top to bottom. So basically what it hit its highest to the lowest over the course of these last 4 months or so. January, February, March, April. Yeah, last 4 months. This does not include today, and the markets are way up today, so it will not include today, so it's going to look better. We're going to see what recovered from its down, and then the 10-year return and the actual dollar amount after 10 years, if that makes sense. So here's the Wellington. The Wellington is so far down 9.61, and here's the S&P 500 down 12.62. So the Wellington is down 300 basis points less than the S&P 500, which is down 25% less, if that makes sense. And the which is interesting because that's the year to date. All right, now the top to bottom, the Wellington fell 25%. The S&P 500 fell 34%. So the S&P 500 fell 900 basis points more than the Wellington. 9 divided by 25 is 36% more than the Wellington did. All right, so the S&P 500 fell by 36% more than the Wellington. We just factor 34 minus 25 is 9. Divide that by this. That's how much more the S&P 500 fell than the Wellington, which is pretty breathtaking if you think about it. I guess you could do the same thing here. You could do 12.62 minus 9.61 divided by 9.61 and 31%. So the S&P 500 is 31% more volatile, or down 31% down more this year so far, even though in this time it was down a third more, which is pretty incredible. That's a lot of volatility, but it doesn't shy away from the fact that the Wellington was still down 25%, a quarter of your capital. That does not make you feel good on that date. And the date that the Wellington hit its lowest was 320, and the date the S&P 500 hit its lowest was, I don't have it on here, 323. All right, so 3 extra days. Whew, on those days, the latter part of March, you're in a world of hurt. I hope you didn't sell out. All right. Now the recovery, the S&P 500 is up 27.26% from the recovery. Wellington was up 19. So a lot of similarities there. Basically, it looks to me about a third to a quarter to a third less risk on the Wellington on the downside, and of course on the upside about a third to a quarter less as high as well. In fact, it's interesting because here's a 10-year, almost identical to what we just said, about a third to a quarter. 10.37 to the S&P 500, 7.89 on the Wellington. So essentially, over the last 10 years, you can see this is where it gets problematic. Can you assume that's going to be the same going forward? I don't know, and I'll tell you why here in a second. But the S&P 500 is up basically, what's that? 10.37 divided by 7.89 divided by, 10.37 minus 7.89 divided by 7.89. The S&P 500, there you go, it was up 31% more than the Wellington over the last 10 years. So, you got a lot more risk, got a lot more upside, got a lot more downside, about 30%, if that makes sense. That's a lot, 300 basis points. And that led to you having $55,000 more in your portfolio at the end of 10 years than the Wellington Fund did. So, again, I don't look at the Wellington Fund as one you want to grow with. I look at it as one you want to retire with, if that makes sense. You don't want to grow with a Wellington. You want to retire with it, in my opinion. And that means when you start pulling distributions out is when you want to have the Wellington, not when you're building your asset base. So, I mean, at the end of 10 years, you left a lot of money on the table, for sure. But you had less risk. But again, that right there is still painful to see. 25% down during those 3 weeks' time. And we're talking from February, where is it? February 12th is at its high at 44.27 to March 20th is at its low. That's a month's time. Crazy. Now what I was saying is the Wellington has value stocks, all right, and the S&P 500, about 65% of that is growth stocks, and we know for the last 10 years, growth have dwarfed value by a factor 2 to 1. So in 2000 to 2010, when value dominated growth, Wellington did better, relatively speaking, than is shown here to the S&P 500 because value did better. So given that value has been out of favor relative to growth, and when I say out of favor, it still made money. This still might be a time to really look at the value stocks because they've underperformed relative to growth, which I think would mean in the next 10 years the S&P 500 would probably get a little bit more even towards the Wellington. Still probably outperform, but not a 30% difference there. Now, if you look at the bond, the Vanguard Total Bond Index, the Ginnie Mae, and the Vanguard Intermediate Corporate Bond, year-to-date, both the Ginnie Mae and the bond index are up. And the reason why the bond index, because it predominantly is treasuries. It's about 70% is going to be treasuries, mortgage-backed securities, and government-sponsored entities, where 30% is going to be corporate bonds. So a 100% corporate bond is actually down for the year, basically breaking even, but it's still down for the year. But look at that. Corporate bond was down 13.3%. Which is more than half of how far down the Wellington was. So the corporate bond fund did not give you a huge reprieve from a pretty significant decline, which is kind of what is reflected back in Wellington because they're going to have a lot of corporate bonds in there as well. The bond index was down 8.5%. Ginnie Mae was down 0.9%, less than 1%. So just not much to write home about. On the recovery, well, Ginnie Mae didn't go down that much. It didn't have that much to recover. The bond recovered 9.2, so fully. It recovered everything. And then the corporate bond did not recover the extent of the losses yet either, which is why we're showing a negative for the year so far. Over 10 years, the bond index is 3.74. The Ginnie Mae's average 3.37, and the corporate bond index is 5.11, which is about right. You get about 125 more basis points for the risk you're taking. I do want to see something real quick. I want to see, if we look, what the 10-year Treasury was 10 years ago. So let's go to treasury.gov, and we're going to see it's May of 2010. Let's see what the Treasury was 10 years ago and see if that gives us some kind of idea. Let's go to 2010 of what we're looking at for Treasury yields at that point. I don't know off the top of my head what the corporate bonds were, but we're just going to look at Treasuries. And so we'll go to May. So May 4th, 2010. The 10-year Treasury is at 3.63. Look at that. 3.63, we got 3.74. And that's just a little bit more because of corporate bonds. Be interesting to see what corporate bonds were doing back then. I don't know. But isn't it ironic? As I've said a million times this Sunday, you know the return on your bonds simply by the yields you're getting. So May of 2010, you're getting 3.63 on a 10-year Treasury. The bond index, BND, gave you 3.74. It's literally that simple. It's a 98% correlation there. It's crazy. So anyway, you can see how that works. So Ginnie Mae survived nicely. The bond index survived nicely again because it has a predominant amount of corporate bond government bonds. We know Wellington and S&P 500 got knocked around quite a bit, and the corporate bond index got hammered pretty good, which makes it just not worth your time for sure. So what I did last time, this is where the mistake I made. Let's compare. All right, we're going to look at what the S&P 500, 65% in that and 35% in Ginnie Mae did over 10 years relative to the Wellington Fund. All right, so we're going to get rid of these two. Oops, oh yeah, that might work. All right, let's get rid of these guys. So what we're going to do here, and this is what you got to do when you're doing any kind of like asset allocation. You say, what's my, that still looks kind of ugly, doesn't it? I'm trying to be professional here, my friends. I mean, professionalism is what you get in my basement. Pablo has been taken for a walk, so you won't hear any dogs barking, other than my feet for standing up. My dogs are barking. All right, so we're going to say the Wellington, the S&P 500 is 0.65. So what we do is we do 0.65, and we times that by the 10-year rate of return, 10.37. All right, it's actually, and I'll show you what I'm talking about, 0.35 times 3.37. All right, 3.37. We take our trusty calculator, and we say, all right, 0.65. And the reason we're doing that, because your portfolio is 100%. Your portfolio is 100% of something. In this case, 65% of that 100% is in this fund right here, and the 10-year return is 10.37. 35% of your portfolio was in this fund right here. The 10-year return is 3.37. So we take 0.65 times by 0.1037. That gives us 0.067. All right, so 0.067. And actually what you do is you go blink, you put the point there, you put the point there, if that makes sense. I hope. Oops. All right, cool. And then we take 0.067, 0.35 times 0.0337. That gives us 0.0117. 0.011. So that gives us 0.078. Oh, well, it's like some guy said right there. It's almost identical to that of the S&P 500, the Wellington, 7.89. Isn't that interesting? Some guy had pointed that out. And my man Rick is the first to point out about the mistake I made. What I did is I took these, what did I do? I forgot. I forgot what I did. I screwed up, and here we're not. So look at that. A 65-35 split between Wellington, between S&P 500 and Ginnie Mae equals almost identical to Wellington returns. Huh, isn't that interesting? It'd be interesting to see what the volatility of these were over the course of that time. Now here's the problem though. The Wellington is going to be more risky because it has corporate bonds. And the risk of the corporate bonds gave it more of a bang for corporate bonds because Ginnie Mae is not corporate, so it has less risk and thus has less returns. So it had more risk but more returns for corporate bonds than Wellington. But Wellington had all value stocks, where the S&P 500 has predominantly growth stocks. So it's kind of like a wash there. I think at the end of the day, though, comparatively speaking, you probably want to look at the Wellington because Wellington has 2/3 of value stocks, and value stocks are undervalued relative to relative to the growth stocks that we've had, at least as of the last 10 years. That's interesting. So I'm glad I redid this. So whoever a bunch of you point that out, good stuff, man, because this is interesting. This had made me think maybe, this just changed my opinion because we are showing it right here. Wellington held up nicely. In a decade where growth outperformed value significantly, it did just as well as the S&P 500 and Ginnie Mae, which bodes well for Wellington in a decade where value stocks do better. Good stuff. All right. So anyway, lots of good stuff in there. And like I always say, if you did not jump off a bridge or slit your wrists and dive from off the top of the Empire State Building into a lake full of starving great white sharks, with blood dripping all down your back, and they're just rip you like Pablo with one of his chew toys, you're fine. If you can survive what we just went through, if you can survive that, you can survive anything. Pat yourself on the back. All right, we'll see you guys. Love to hear your comments. And again, appreciate the heads up, man. I don't want mistakes being out there. So good on you guys. We'll see you.